Hey there, and welcome back to the Deep Dive. Today, we're navigating the reports for a major infrastructure investment trust here in India.
Yep.
Trying to cut through the numbers, really, to bring you the essential story. We've got, well, quite a stack of sources, board meeting outcomes, detailed financials, notes, all focused on Energy Infrastructure Trust, or EIT.
That's right. You've handed us the raw material from NCAP Investment Manager Private Limited. That's the trust's manager.
Right.
Covers the financial year that just wrapped up, March 31st, 2025. So think of this deep dive as, getting the key takeaways.
Helping you understand the performance, the financial health, without getting sort of bogged down in every single detail.
Exactly. Our mission is to unpack what stands out, what's changed, and what it means for anyone interested in this trust.
Okay, so let's jump right in. Where should we start?
Well, first off, let's just level set on what EIT actually is. It's an infrastructure investment trust, an INVIT.
The VTI, right.
So if you're not familiar, maybe picture it like a mutual fund, but instead of stocks, it holds infrastructure assets. In this specific case, it's a natural gas pipeline. And the name's pretty recent, too. It changed back in November 2024. It used to be India Infrastructure Trust.
And the manager, NCAP Investment Manager Private Limited, they also had a name change, didn't they? June 2024.
Yeah, formerly Brookfield India Infrastructure Manager. So lots of name changes, but the core entity structure is what we're looking at. Their report on the trust's performance, half year and full year, ending March 31st, 2025.
Okay, and you mentioned the financials have two views, standalone and consolidated.
That's right. Standalone is just the trust itself. Consolidated, that includes its key asset, Pipeline Infrastructure Limited. That's the subsidiary running the gas pipeline.
Got it. Okay, let's tackle that standalone view first then. What are the top-line numbers showing just for the trust?
Okay, so standalone for the year ended March 31st, 2025. Total income and gains were Rs 848.61 crore.
848.61 crore. How does that compare?
Well, it's a noticeable decrease from the year before. That was Rs 110.10 sang crore.
Quite a dip then, just at the trust level. What was sort of driving that?
The sources point pretty clearly to the fair value gain on the trust's non-convertible debentures. That seems to be a major factor.
Ah, the NCDs.
Yeah. In FY25, that gain was Rs 298.83 crore, but in FY24, it was much higher, Rs 533.82 crore.
Wow, less than half.
Exactly. So this mark-to-market accounting adjustment, it really impacts the reported standalone income, and consequently, the standalone profit after tax followed suit. It fell from Rs 1,079.23 crore in FY24 down to Rs 820.87 crore in FY25.
Okay, so the reported profit at the trust level itself was down, mainly because of these, let's call them paper gains or accounting changes on investments, not necessarily the core operation itself.
It's a good way to put it, yeah.
But you mentioned the consolidated view includes the actual pipeline subsidiary.
I did, and this is where the picture, well, it shifts quite a bit. Looking at the consolidated figures, the ones that capture the pipeline operations performance, the total income and gains for the year ending March 31st, 2025 actually increased.
Increased, okay.
Yeah, up to Rs 4,036.23 crore from Rs 3,842.70 crore in FY24.
Wait a minute now. Consolidated income from the actual asset operation went UP, but the reported standalone income at the trust level went down. That feels, well, counterintuitive.
Yeah.
How did that affect the bottom line then, the consolidated profit?
Well, that's the twist. While consolidated income increased, the total consolidated expenses and losses, they saw a dramatic jump.
A jump? How big?
They rose to Rs 4,026.29 crore in FY25. Compare that to Rs 3,019.24 crore in FY24.
Okay, that's a huge increase in expenses, over 1,000 crore more.
Exactly. And this surge in costs, it meant the consolidated profit after tax for FY25 was just Rs 8.96 crore.
8.96 crore, down from, what was it last year?
Down from Rs 822.02 crore reported the previous year.
Wow. Okay, that is a dramatic change. Consolidated profit basically vanishing despite higher revenue. We need to dig into that. What specific expense caused such a massive swing?
Right. If we connect this to the detailed notes, the source material highlights the primary driver. It's within other expenses at the consolidated level.
Okay.
For FY25, these expenses included a huge chunk, Rs 1,671.51 crore, labeled as the RIL upside expense.
1,671 crore. Just for that one line item.
Yeah. And compare that to FY24, where it was Rs 472.79 crore under the same label.
RL upside expense. That
What's
sounds
that?
significant. It's clearly the culprit for the profit drop.
Yeah.
What exactly is this expense? Why is it so large all of a sudden?
Okay, so the notes explain it. This expense is paid by the subsidiary Pipeline Infrastructure Limited to Reliance Industries Limited, RIL.
To RL. Okay.
It's essentially a payment made under the terms of their pipeline usage agreement, the PUA.
Right.
So in exchange for RIL providing certainty of cash flows for the pipeline operation.
Ah, so it's like a guaranteed revenue mechanism.
Kind of, yeah. The subsidiary pays this upside expense. It's a contractual thing designed to ensure stable revenue for the asset, which then flows up to the trust.
Okay, I see.
And the significant increase in this specific payment this year, that's what overwhelmed the higher consolidated revenue and just, well, decimated the reported consolidated profit.
So the pipeline itself made more money, but the contract meant a much, much bigger slice had to be paid out to RAL this year compared to last. That explains the plunge in profit.
Precisely.
But, okay, for investors in an NVIT, reported accounting profit isn't always the main number, is it? Doesn't it really come down to the cash being generated, the distributions?
Well, exactly. You've hit on a really important point about NVITs versus, say, regular companies. SEBI regulations actually require NVITs to distribute a big chunk, at least 90% of their net distributable cash flows.
NDC,
Yeah.
DCF, right. That's the key metric.
It is. So while accounting profit tells you one story, based on accruals, fair values, things like that, NDCF tells you the story of the actual cash available to be paid out. Much more relevant for unit holders often.
And the documents, do they give us those crucial NDCF figures?
They do, yeah. The source details the calculation. It's basically cash from operations and investments, then adjusted for things like, debt payments, reserves, capital spending.
Okay. So what was the number for FY25?
For the financial year ended March 31st, 2025, the standalone trust-level NDCF, now calculated under a new SEBI framework that kicked in April 1st, 2024.
Ah, a change in rules. Good to know.
Yes. Under that new framework, it was Rs 1,007.00 crore.
1,007 crore.
Yeah.
Okay, how does that standalone NDCF compare to the previous year? Keeping that framework change in mind, of course.
Right. Under the previous framework, the FY24 trust-level NDCF was Rs 1,062.55 crore.
So a slight decrease on paper, but maybe influenced by the rule change.
Could be, yeah. But interestingly, the reports also give us another figure. Net distributable cash flows, including surplus cash at trust level.
Okay, a broader measure that.
Exactly. Includes any extra cash sitting at the trust level.
Mm.
And for FY25, that figure was Rs 11,142.35 crore.
1,142 crore. How does that compare to FY24?
Well, that's actually an increase from the Rs. 973.06 crore reported for FY24.
Wow, okay, hold on. So let me get this straight. The reported consolidated profit basically fell off a cliff because of that big RIL expense.
Mm-hmm.
But the actual cash available for distribution to unit holders, when you include the surplus cash, that increased year over year.
That's exactly what the numbers show, yeah.
That is a critical distinction. It really highlights why you absolutely cannot just look at the profit number for an NVIT, can you?
You really can't. It's misleading on its own. The contractual RIL expense hits the P&L hard, the accounting profit. But the core cash generation from the pipeline, plus that surplus cash, was strong enough to support a higher level of distributable cash this year.
So did that higher available cash flow actually translate into higher distributions for the people holding units?
Yes, it did. The board meeting notes confirm it. They declare distributions during FY25, 4 quarterly ones. April, July, October 2024, and January 2025.
And the total payout?
Totaled Rs 17.1786 per unit for the financial year.
Okay. And wasn't there another one declared right after the year ended?
That's right. Yep. The documents mention a distribution declared on April 10th, 2025. So the practice continues.
So the total cash paid out for the year ended March 31st, 2025.
That total amount paid out was Rs 11,140.66 crore.
Which is higher than the previous year, right?
Indeed, higher than the Rs. 973.06 crore paid out in the year ended March 31st, 2024. So more cash became available and more cash was actually distributed.
Okay, that cash flow and distribution story is quite different from the profit story. What else did the documents tell us about the trust's sort of underlying value?
Well, the board meeting outcome also includes the net asset value, the NAV per unit. That's based on an independent valuation report.
Ah, the NAV.
Yeah.
Gives you a sense of the asset backing per unit. What was the figure?
As of March 31st, 2025, the declared NAV per unit was Rs 88.35.
88.35. How does that stack up against the previous year's valuation?
Well, the documents show the NAV as on March 31st, 2024 was Rs 99.00.
99. So it decreased then.
Yeah, the NAV per unit decreased by over 10% from the end of FY24 to the end of FY25. That's according to the independent valuer's assessment anyway.
Interesting. So cash available for distribution went up, actual distributions went up, but the assessed underlying value per unit went down. A bit of a mixed picture there.
It is, yeah. Different metrics telling slightly different parts of the story.
What other notable details sort of topped up in these sources? Anything else stand out?
A few things. The trust maintains strong corporate credit ratings. That's worth mentioning.
From whom?
Crissell and Care both reaffirmed their A-stable ratings. That's the highest level, suggesting, a high degree of creditworthiness.
Okay, good context.
Yeah.
Anything else on structure or operations?
The documents also give quite a bit of transparency into related parties and transactions. You see the key relationships laid out.
Like the sponsor.
Yeah, the sponsor, which is Rapid2 Holdings in Singapore, the investment manager, NCAP, the project manager, the trustee, and of course the subsidiary, Pipeline Infrastructure Limited.
So you can see the whole network.
Right. And they list transactions with entities within the broader group, service providers. It helps you understand the structure and, where money flows between related entities.
Useful for tracking potential conflicts or synergies.
Exactly. There's also a bit of a technical note about how the unit capital is presented on the balance sheet.
Oh.
Just that while accounting standards might view it as a sort of compound instrument because of that distribution obligation we talked about.
Right, the 90% payout rule.
Yeah. It's actually presented as equity to comply with SEBI regulations for NVITs. It's more of an accounting presentation point, doesn't really change the reality for unit holders getting distributions based on NDCF.
Okay, and any major changes in commitments or liabilities?
The consolidated financials show commitments decreased significantly, down from about Rs 15.4 crore in FY24 to just Rs 2.85 crore in FY25.
Fewer future obligations then.
Seems so. And no contingent liabilities reported at either year end, so nothing sort of hanging over them unexpectedly based on these reports.
Okay, that covers a lot of ground. Let's maybe try and quickly summarize the key takeaways from this deep dive.
Sure. So we saw Energy Infrastructure Trust's standalone reported profit was down in FY25. That was influenced quite a bit by lower fair value gains on its investments.
Right, the paper gains.
Then, crucially, the consolidated reported profit that saw that huge drop fell off a cliff, really.
Yeah.
And that was primarily driven by the massive increase in that RIL upside expense paid by the pipeline subsidiary, part of that contractual deal for cash flow certainty.
And this is the big but for an NVIT looking at the cash flow picture.
Exactly. The net distributable cash flow, especially when including surplus cash, actually increased year over year.
Which led to higher total distributions being paid out to unit holders in FY25 compared to FY24, even though the consolidated accounting profit looked terrible.
Right. And alongside that, the independent valuation reported a decrease in the net asset value, the NAV, per unit over the year.
It really is a fascinating case study. It shows how just looking at standard accounting profit for an NVIT can be, pretty misleading.
Absolutely. You have to look at those underlying contracts, the cash flow generation, the distribution policy. That's where the real story often lies for investors.
Definitely. And, that leads us to something for you, the listener, to consider as you process this information. Given that a significant chunk of the revenue is being paid out under this long-term contract, specifically designed for cash flow certainty, how do you weigh that trade-off?
The trade-off
between maximizing reported profit in any single year versus ensuring those stable, predictable cash flows over the longer term. How does that influence your assessment of the investment's value, its risk?
Yeah, that's a really important question to weigh when looking at these kinds of infrastructure assets with long-term agreements. Stability versus reported upside in a given period.
Something to think about. Well, that's all the time we have for this deep dive into the Energy Infrastructure Trust reports. We really hope this was helpful in highlighting the key takeaways for you.
Yeah, thanks for joining us.
See you next time for another deep dive.